Hello, guys, what is happening? And welcome to today's live stream. So, I literally got back from the UK last night, yesterday evening, I suppose. So, I'm quite jet lagged because essentially the time difference means that it's like the middle of the early hours of tomorrow morning in England right now. But anyway, we're going to power through this. The thing is, there is no time for jet lag this week because this is an incredibly important week for so many different things when it comes to macro and economics and real world economics playing out in front of our eyes. So this week, incredibly important week. We got a lot of different things to go through today. Tomorrow is the US, the United States is reporting their CPI number. So that will be an incredibly volatile day as well. And on Wednesday, then we've got the Bank of Canada's long awaited interest rate decision and monetary policy report that's going to come out. Now, there's a speculation on what's going to happen there. Could be 25 basis points, could be 50 basis points. I think the probability of it being 50 basis points is probably around 60%. So the odds are good, but there's still a chance it could not happen. 40% is still a big number as well. And the chance of a 25 basis point hike, I think, is around 90%, really. That's just pretty much guaranteed. It's whether this 50 basis point hike is going to happen or it's not going to happen. And yeah, Greg in the house there, I hope it happens as well, 0.5%. I think it would really rattle the real estate market at this crucial point where we've had one interest rate hike, but fixed rates are going parabolic and housing prices are down across the country. So let's get into the markets first. So it's Monday, April 11th, for those of you that listen on the podcast, because you are going to see this differently. So what am I doing here? I'm already getting things wrong. All right, here we go. So the markets today, they were down quite a bit, to be fair, and the NASDAQ has come off quite a lot. So gold ended the day up, but the major indices were all down. So you had the DAX off, the NASDAQ was down significantly, treasury yields were up, and the S&P was down significantly, as was the Dow Industrial Average, but the NASDAQ and the S&P slipping way more than the Dow. Now, the interesting thing is treasury yields were up. So that means there was not a flight into bonds for safe haven during this sell-off today. We've seen this, guys, the thing is, I've seen this a lot over the past couple of months where the market's down, treasury yields are up, and that's not a good sign. Normally, years ago with MMT and everything like that, as soon as the market starts crashing, everybody rushes into bonds. But the thing is, these bonds are no longer safe because inflation is running so high. And we're going to get into the real nitty gritty of that today, because I think it's really important. And that's why I titled this stream, Taxes Will Explode Higher, because what people are underestimating with the rise in the bond yields is the fact that interest rates have to rise then for what the government is paying. The yields that they're having to pay on these bond yields have gone up significantly. So they now have way more debt than they've ever had in the past. A lot of these governments like Canada, the United States, the UK, Europe, they've spent so much money with the cerveza sickness. And the amount of debt they have, the interest payments are going to be much larger. So to fulfill these debt payments, they're going to have to raise taxes. They're going to have to raise funds. And that's what people are really underestimating. And this is something that's going to happen over the longer term horizon, but it's still going to happen nevertheless. Those tax increases are going to come. Interestingly enough, the Canadian dollar is down now. It's around 79 cents. It's come off quite a bit since whenever it was, like a week or two ago. It was near, I think it was like 85 or something like that. Not 85 cents, like 80.5 or 81. I think it even got to 81. But anyway, Trader 586, hey, G. Ellis, I want real estate to crash and burn. Well, you might just get that. You might just get that wish in actual fact. So let's go over to the bonds. The reason I'm doing this at the start is because it's just for the benefit of everybody so they can hear this, because I think this is really important, what's happening in the markets right now. And as we go throughout these streams that we're going to have, and we may have 2 or 3 this week with everything that's going on, they're not going to be really long episodes, though. I'm going to try and jam everything in as quickly as I possibly can. So if you look at the yields, the 1 year pretty much down. Wait a second, is that 2 basis points? I'm confused by that. Looks like it's down. Let's have a look. I'm just having a look here. Yeah, that doesn't make any sense. So ignore that -2. But basically, the 2 year was up nearly 6 basis points. The 5 year is up nearly 4 basis points. The 10 year is up 10 basis points. And the 30 year is up 10.5 basis points, nearly heading towards 11, 10.6 basis points. DXY up. All the UK bonds up, the New Zealand bonds also up, Australia bonds also up significantly, and the US Treasuries also up significantly. So that is big news. Really, a lot of people will think that that means nothing. I don't know why you talk about bonds so much, but bonds are incredibly important. If we go back to the markets, when those bonds yields start rising, it affects everything. So if we look at JNK, which is junk debt, I want to show you something because it's really, really interesting to see this. And believe me, you'll want to save this for the history books. If you look at this, so we're now down at 99.27, which is near its 1 year low right now. And we're actually at the 1 year low by the look of it. The last low that it put in 99.60, which we covered on this live stream. And then we had a sort of rally, which was bizarre because it happened with junk debt and corporate debt. We didn't see that same sort of significant rally that we saw in junk debt, corporate debt, in government debt, which is kind of weird. But if you look at this on a 5 year, it's now heading way down. So we're now below this 2018 where the market just absolutely tanked. I think that was when the Dow just crashed on Christmas Eve, I think it was. And then you've got the cerveza sickness market crash, and it got down to 86.14. But if you look at it, it's well below all its supports. So it's heading a lot lower, and this is not good news. But if you scroll down on here, this is what I wanted to show you guys, because this was 6 months ago. So you can imagine that the yield, if we go to a 6-month chart on this, you can see that it has gone down a lot, significantly. This is a big move for a bond, and it has gone down loads. So 6 months, it's dropped off a cliff. But if you look at that, defaults among low quality companies at 2007 lows. Again, we're seeing that 2007 number, which reoccurs just like we saw inventories at the lowest level since 2007 in the real estate market. Yet people think They just can't connect the dots around that. Are we at the end of a cycle? If these things are lining up, it's entirely possible. You just got to look around. So it's thank you, Sammy. Trader 586. All the zombie companies are finally going to hit the wall. Yeah, because these yields, they're going up significantly. I think the yield on this is near it. It's 4.47%, the yield on junk debt right now. But it's not just junk debt that is going down. It is also everything else. It's also stocks. It's also corporate debt. It's also this these bonds as well. So if we look at corporate debt and that simplify interest rate hedge is such a wonder, and I can thank Michael Burry for that call. But basically, if you look at all of these, you've got Vanguard, they're all down significantly. And if you look at, I think it's this XCB one of the two is like really down. So if you look at these Canadian ones, they're selling off even harder. So the fact is that these Canadian companies are even less likely to be paying back this money because the yields are jumping so significantly. Like these are yields not seen since the crash before. And if you look, 1976, going way back, you haven't seen that number since June 2009, which wasn't exactly a great time for the economy. G. Ellis says, here's an example of real estate in Vancouver. Homes sold in Maple Ridge in 2019 for $1.25 million. Now, exactly 3 years later, seller wants $2.1 million for the house. Nice home built in 2016. Yeah, that just shows the just lunacy in the market, essentially, and pictures it well. So, same thing in New Brunswick, 100% up. Some are real hellholes. I mean, who buys these? People with FOMO, lots of different people. People who want to become like landlords essentially and are looking for an investment property, they'll buy it. People from Ontario, people from Ontario and BC, the lower mainland and the GTA, they have lots of equity which they have pumped into different areas of the real estate market. Like BC has been Alberta and rural BC mainly, but it has tipped into Alberta as well. Ontario has mostly been focused around the East Coast, New Brunswick, Nova Scotia. You've seen the values, and rural Ontario. But you look at like Saskatchewan and Alberta, they haven't really gone up at the same pace. And it's going to be a really interesting show when this all goes down, which is starting to go down because a lot of the markets were down this month. So we're going to head over quickly now, and I'm going to show you a chart, which is real residential property prices for Canada. And this is going to give you some perspective on where we're heading. Because if you look at this chart, this is adjusted for inflation for start off. When we're talking about residential real estate prices, we always want to go inflation adjusted, not nominal values. Sometimes you can have, in a high inflationary environment, nominal values are rising, but they're not rising at the pace of inflation, so they're actually declining. And that actually happens a lot because it happens in Turkey. Like Turkey's real estate has gone down in real terms, but up in nominal value. So you've got to really be listening to that. US being first again. Thank you so much for that super chat. What do you think crashes first, real estate or stocks? Stocks, 100%. Real estate is a slow mover. I think the stock market will crash first, 100%, because it's just a faster moving market. The real estate, as you're going to see in the video that comes out this Wednesday, I basically describe it as this ship that's turning around. It's like a huge ship. It's not like the stock market, which is like a speedboat and can just do a U-turn in 5 seconds. The real estate market takes time. Although, having said that, real estate prices went down in a lot of markets in April. And, I mean in March, sorry, the jet lag. But the thing is, that was one interest rate hike of 25 basis points, and then plus all the fixed rises and fixed rates and everything like that, which only really started to happen in the latter part of the month because of the Ukraine situation and everything like that. There was an initial burst into bonds, and then it fell away. So it's going to be really interesting, I think. But I do think stocks will crash first, definitely. Well, not definitely. Nothing is definite. Probabilities are the key thing here, but I think it's more probable that stocks crash first than real estate. But we could be at the start of the real estate crash already, which would just be insane. But yeah, we could be. These prices are the reason I'm on track to become an alcoholic, Greg says. Oh, shit. Oh, no. My only stock purchase last month were uranium miners. Nice. I'm not like too much into that market, so I don't know enough about it to really talk about it. But basically, let's take a look at this chart. So this is real residential property prices for Canada. So I want to go back here because basically soon enough, we're going to have fixed mortgage rates here in Canada at 2009 levels. So if you look at this chart, let's just say 2010 to make the math easier. On the index then, it was 100, and now it's at what's it at now? 161. So, that could be a massive decline in prices if you really think about it from that level. Now, I wish this chart actually showed the price, because then it would be easier to tell you, but instead it's these index values. But you can basically tell, like, this could be anywhere between a 40 to 80% decline in prices. Like, it's significant. And the thing is, the front end of the curve is going to take longer to catch up, because the thing is, the Fed, the Bank of Canada, they're going to have to start to raise the front end, the 1 years, the 3 months, the 1 month. And that's when they raise their overnight interest rate. That's when that's going to happen. So your variable rates are really still an option for people. They're an incredibly risky option that people are going to be taking, of course, because they've got FOMO, everything like that. But really, guys, let's just think logically here. Like, would you want to buy a house in this environment? Now, I know 99% of you are going to say no, you're not going to want to. But the real thing is, like, I can't get into the frame of mind of like who would want to buy in this environment, because the thing is, with interest rates rising, you don't know what point that's going to go to. With interest rates rising, you don't know what point that's going to go to. So it's just really interesting dynamic that we've got going on right now in the market, where you've got people buying and still FOMOing in, and that's going to get less and less, but it's definitely still there, and it's not going away yet. There are people. So I spoke to a realtor who'd emailed me over this weekend, and they're basically here in Alberta, and they were saying, like, they've got in their market, they've got houses that are selling below asking price, and then they've got houses that are selling above asking price, because some people still have FOMO. They haven't sensed that the market is shifted, whilst others have. And there are a lot of sellers, he's saying, that are coming on, and they're fearful. So fear is definitely coming into the market. But you just think, if interest rates get to that 2009, 2010 levels, like, prices will then need to adjust in real terms down to those levels for everything to be an equal playing field in the market, unless there's any other measures which make the payments that people have cheaper, which they're not going to be if interest rates are going up. And people aren't earning any more money. Like people's wages adjusted for inflation, negative, not positive. People's taxes, the carbon tax, just come in. There's going to be more taxes. Like, don't be naive here. With all the bond yields exploding, that is the government paying more for their debt at the shorter end, at the longer end. And that's the reason that the budget was a little bit, it was a little bit smaller than I would have thought they would have come out with. But then I thought, well, with interest rates and everything like that, they're probably trying to keep it smaller so they don't have to jack up taxes at this point anyway. But we all know that they'll try and get us one way or the other. It's just a question of when. So the thing is, the government doesn't really care about the residential real estate market. Oh, wow, I said it. You know, a lot of people just don't understand that these people, like, let's take Tiff McClem for an example. So Tiff McClem knows he's going to raise rates a lot. Do you not think that his advisor, like let's say he owns a portfolio of rental properties, has then said, you know what, we'll sell them all. We'll sell all those rental properties and then you can buy at a lower date when prices drop. Like, I mean, this is the thing that the average Joe and Jane doesn't really do, because like the average mom and pop landlord, like them being a landlord, the portfolio percentage that is real estate is typically very high. It's typically like 80-90% of their net wealth is in real estate. So the thing is, because there's that fear factor of that's their entire thing, whereas people like Tiff McClem, people who have serious money, rich people, they normally, statistics are all out there on this, the portion of their portfolio that's real estate is actually very low compared to the average Joe and Jane. So who gets affected the most by real estate prices declining? It isn't the rich, it's the average Joe and Jane. Now, don't get me wrong, there can be rich people that can be real estate heavy and everything like that. But you have to really look at it from that perspective, because I know a lot of people think, oh, well, you know what, the government, they don't want housing prices. No, there is definitely influences in there from banks and real estate organizations and everything like that that influence local governments, even provincial governments, federal governments, possibly. But when it comes to monetary policy, interest rates and inflation and everything like that, I'm sorry, but the housing market is going to be in the back seat to that. And that's what people don't really understand. They haven't really realized that at this point. They just think that, you know what, if inflation continues to be hot and the stock market crashes, the Fed's going to come save them. Or inflation's really hot and the real estate market crashes and the Fed's going to come and save them. And that very well might be the case. But the chances are, looking at history in the past, that's not going to happen. And how do these people generally formulate their decisions and calculate their decisions? They do it based on the past. So the thing is, that's why they believe raising rates is going to bring down inflation, when me and you, we know it ain't going to happen, because they're never going to get to a real rate of interest. So the funny thing is, we're going to now head over to something from 2007, another thing from 2007, which I want to show you, because you're really going to, I've highlighted a bit of this article. I really want to show it and share it with you, because it's so important to look at the past to really understand going forward what's going to happen. So if we look at this, a fright in the bond markets may end the cheap money era. Okay, so this month's sell-off in the bond market is already a landmark event. The fall in bond prices, both in the US and Europe, has been as sharp as any have seen this decade. The consequent rise in yields has forced investors to re-examine the cozy assumptions that have underpinned the cheap financing available across the world for the past few years. Now the question is how great the impact will be. US Treasury bond yields in effect set the risk-free rate used when pricing securities. That basically means, to those of you that don't know, is the US bonds, the treasuries are the government bonds. So they are basically always going to be paid. Like the government of Canada, the US government hasn't defaulted on these bonds or treasuries. It's not like corporate debt, junk debt, which is more risky. So in effect, they're risk-free. And in fact, treasury bonds are often seen as good as cash, but they actually have a yield. And the same with like government of Canada bonds or any of these Western governments, they've often been seen as good as cash. So a lot of people would rather hold treasuries than just hold a pile of cash, because at least with treasuries, you're getting some yield. Even it might not be that much, but you're getting something. So that's just what that is. From corporate credit through derivative contracts to equities across the world, they form the financial world's clearest expression of risk. Remember that. So we jump down here. Thus, the market entered a free-for-all that took it passed further important landmarks. Once 10-year yields passed 5.25%, 10-year rates were higher than the Fed funds rate, which the Federal Reserve charges to banks for overnight loans. This ended almost a year ago when these bond rates had been lower. Normally, short-term rates are below long-term ones, as investors demand a higher return for taking the bigger risk of lending for longer periods. The 10-year yield also reached its highest level since 2002. It rebounded a little on Friday and ended the last week at 5.15%, even as the Fed repeatedly raised overnight rates from 1% in 2004 all the way to 5.25%. Just goes to show how quick rates can change. Longer bond yields had barely moved. Alan Greenspan, former Fed chairman, dubbed the failure of long-term rates to react as a conundrum. That conundrum may now be over. Long-term bond rates coexisted with cheap financing to fuel a boom in US housing and enable private equity firms to make ever more ambitious buyouts, like buying your real estate, like BlackRock. With money easy to come by, there were fewer forced sales of assets, so asset prices go up. Hence, price volatility declined, like we've seen since 2008. That kept bond yields well behaved and lulled investors to believe the era of low-cost financing world would continue indefinitely. In turn, it became cheap to insure against volatility through derivatives, which have boomed, like CDS, like other different things, basically. Collateralized debt obligations, all different things. So I think that was basically it. Yeah, it was. But the thing is that I think there's a lot of importance that we need to recognize in that, because, you know, that was written in 2007. They did not have core CPI explode into the level we have today in 2007. They were not facing all these external factors like droughts, wars, and all these other things that we have right now that are affecting inflation. So you have to think about that. Even if there is a recession, there's disinflation, is it going to be short-lived? How's it going to work? You have to kind of plot out the course of what you think is going to happen using probabilities and using what you see right now, the events unfolding in front of our eyes. But I think it's incredibly important to look at these articles. I mean, even then they were saying the cheap money era coming to an end. But I seriously believe this time it could be the case, because inflation, this is the start of a inflation cycle that we have not seen since the 1970s. And these cycles don't last 1 or 2 or 3 years. They last 8 or 9 or 10 or 11 or 15 or 20, 25 years. They don't just start and end. So it's important to remember that. And if you think about how prices rise, it's all logical, isn't it? Because you think about it, if businesses get used to just jacking the prices up every year, well, pretty soon that becomes the norm for everybody. And then it becomes pretty difficult to reverse that. Now, if there's a recession, will certain things go down in price? Absolutely. But will those things affect the CPI, which is measured by the government? Will it affect the real inflation rate that me and you pay? Will it affect the core, and the real core is food, energy, things like that, things that we actually need to buy. And those are the things that we have so many external factors basically pressing against that right now. So the second thing I wanted to go over, man, my throat's dry already. All right. So the second thing I wanted to go over is this, and it's important. This is coming from Moody's. They're okay. I mean, let's face it, they're not the best, but why won't this work? What did I do wrong here? Oh, there we go. Okay, perfect. Canadian mortgage rates to surge demand will be the slowest in recent history. You could remove Canadian, you could put American, you could put New Zealand, and soon you could put the UK too. Because the interesting thing, we'll just go over that, is I see the same patterns happening in the UK when I was there that we had in Canada just 3-4 months ago. Like, prices are at all-time highs right now in the UK. Inventory is at all-time lows. And that is because interest rates are still very, very low compared to historically. So the gilts, which are the government bonds in the UK, are rising rapidly. However, they're not at the levels you see in Canada, New Zealand, and the United States. So it is interesting to look at the UK, but they're like 3, 4, 5 months behind, just like we're 3 or 4 months behind New Zealand. So basically, I highlighted some stuff here that I wanted to go for. So again, look, here we go with around the Great Recession. Canadian mortgage rates forecast to hit 2009 levels. They put forecast twice there. Just realized that. And I'm jet lagged, or maybe I'm reading it wrong. Canadian mortgage rates are forecast to surge to the highest level in over a decade. Moody's has forecasted 5-year fixed rate mortgages will reach 4.25% by the end of this year. This would be similar to costs briefly seen in 2019. Mortgage rates are then seen climbing to 5.5% around the end of 2024. Canadians last saw mortgage rates at this level in 2009 during the Great Recession. Now, I think that's extremely modest. I'm going to be totally honest with you, because if you look at the way yields have risen over the past 3-4 months and then kind of just run that out through the year, you're looking at 5.5% by the end of the summer, not the end of 2024. And especially if the Bank of Canada is doing 50 basis point hikes, those yields, they're going to be rising significantly on the 5-year for sure. So I honestly believe mortgage rates, they're just going to keep going up, which puts more downward pressure on prices. It means the probabilities of prices going down are higher than going up. So then in that case, why would you buy if you're holding for price appreciation, which, as I've said, all the investors in Canada, that's mostly what they're buying for, price appreciation. So what's the point in it? And also it affects people's equity because people have no money. in countries like Canada and the United States. And when I say money, I actually mean cash, not debt. There's a difference. Like people have lots of debt that they can get out of their house and put into investment properties, but actual cash that they've saved that doesn't have something tied to it, that is doesn't have a lien on it or whatever you want to call it, they don't have that. So when their equity is going down, do you think they're more or less likely to take out a massive chunk of it? They're less likely to take out a massive chunk of it. So that means investor demand is going to go down as well. So that means people buying right now, like that, the probabilities are stacked against them that the price is going to go down. And then they really have to think in their head when their mortgage renewal comes up, are they going to be in balance? Like if prices are down 20, 30%. Put it this way, and I'm not giving financial advice, but I think people would have to be insane to be putting less than 20% down on a house right now, because they're seriously putting themselves at risk when it comes to refinancing. That's just it's just a hell of a bet, put it that way. But yeah, Canadians last saw mortgage rates this low in 2009 during the Great Recession. Again, so we hear that during the Great Recession, which didn't really last that long in Canada. But we've done that in many other videos that you can go and see on the channel. But that was pretty much all that I had from that article. So I think there was a couple of things that I wanted to show you. I just wanted to show you this real quick with the NASDAQ. So I put out this basically, it was saying about this .com bubble repeat that we could have on our hands here. And it looked like the same pattern as we saw in 2000. And I just want to show you what's happening, because we're just going to continue to monitor this as it goes on. It literally went up and followed the target. And this is where I put the prediction in. So 29th of March, I guess. And then you can see that was literally the top. I mean, I couldn't have been better if I called it. And that was just pure luck, put it that way. That was nothing on my part. That was just pure luck, in a sense that was the last top candle. But I knew the top was going to be around this area. And then I was expecting it was going to pull back, then go higher, and then crash. But we've actually failed at this first major support. So that tells me that the NASDAQ is incredibly weak, even after that massive rise that we had. So, people who are investing in tech, buying the dip, which is a lot of people, again, these people are just going to be strung up. And the thing is, it's like I said in that video, which I filmed in February or March. I think it was in February. I filmed that video, the one I put out about the stock market. But what I said in that is very true. Like, people are going to miss out on opportunities because they're going to be holding the bag. Like, a lot of people will say, well, I'm buying this for long term, Luke. It doesn't really matter. Okay, that's fine. But then what happens if another opportunity comes along that is just, they don't come along very often, like a housing market crash, and then you can't buy. And because you're holding the bag on a bunch of investments that are worth absolutely nothing. And I really think when it comes to NASDAQ, this is going to be a .com bubble type scenario. A lot of these stocks like Tesla are going down and they're never going to come back. And when I say they're never going to come back, they're not going to come back for 20 years plus, just like we've seen with the .com bubble. Loads of stocks that have never come back from their .com bubble peaks. And a lot of them will fail to exist. They'll get delisted as well. It will be a nightmare. These companies are these tech companies who make no money, pretty much a lot of them, are they're at the most risk of going bankrupt because they have such a large amount of debt, and that debt is financed through bonds, and they have just rammed the bonds out during the pervasive sickness because yields have been so low. But now all those bond yields are exploding. So a lot of these tech companies have got into more and more debt, just expecting that interest rates are going to be low forever. And that has like completely been tipped upside down on them. So I think it's interesting. We'll continue to follow, continue to look into that. But yeah, it's basically kind of crazy when you think about it, because, all this stuff that's happening right now, it just doesn't really sound to me like good news. Does it sound to you like good news? Because I just don't think it is going to end well. I just think it's going to end very, very badly. And yeah, so let's see what you guys are saying in the chat before I fall asleep. If I messed up, by the way, on this live stream again, like I'm incredibly jet lagged. If you didn't see the start of this stream, like I only got back yesterday, but we've got a lot to cover this week. We've got the CPI tomorrow, the interest rate decision on Wednesday from the Bank of Canada. There's a lot of data that's coming out this week that we're going to be covering in live stream. So I'm going to keep this one shorter. David Sutton's in the house from New Zealand. So what's it basically saying? G. Ellis says the local real estate broker in Vancouver does YouTube video and preaches to this day, don't try to time the real estate market. He says it's impossible to do so. I always find it funny when people say it's impossible to time the markets. That's usually just an excuse for their negligence, in my opinion. It's very easy to time the markets, actually. You just got to open your eyes. Like, people just don't open their eyes. You've just got to look. You've just got to not have a bias. Like, the thing is, people just normally have a bias. Like, if you're waiting for a market crash because you want to buy, then you do have a bias because it's in your best interest that the market crashes. And then if you're selling, it's in your best interest that the market goes up. Or if you're a homeowner, it's in your best interest that the market goes up. So you're going to go towards that bias that the market's going to go up. Whereas I have to be impartial with everything that I do. Otherwise, I would be a terrible train wreck of a trader, because that is the reason that 90% of people fail in day trading. It's because they cannot trade without a bias. And it's very difficult to do so. Don't get me wrong. Even I fail some days just like everybody else. But that is really the key. It's mastering your mind. It's not so much about everything else. And everything boils down to psychology in the end. It really does. Because even the real estate market, once that psychology shifts, then that's what really turns the prices. Once you got that fear of the sellers are really fearing that they're going to lose lots of money if they continue to hold, so they need to sell fast. And when the buyers are thinking, well, I'm just going to let this play out because prices are going down. And that's what happens when prices start going down month over month. More and more people get pushed onto the sidelines. So it's incredibly important to do. But yeah, people say that all the time with stocks. And I'm like, well, how did I manage to time? Like, you're never going to time the exact bottom. And I think that's what people get messed up with. You can time the bottom, you can time the top pretty easily. But the exact top and bottom, no, nobody's ever going to time that. But really, it's just what's going on in that space, and you've got to do your research on it and basically decide yourself. But you don't want to have a bias. You want to make sure that your opinion stays unbiased, because that is the best way. And that's how I'm able to report on this. unbiased because I ain't looking to buy in Canada. I would never buy in Canada. So the thing is, it doesn't affect me if prices go up or down. I just see the market as it is, which is a giant Ponzi scheme. And I just see the macroeconomics and different things that are going on within the economy as it is, instead of seeing it with rose tinted glasses. It's just something like that. So basically, I traded Trader 586. I traded the text through 1999. Market feels very similar to that. I bet it does, especially with the hype. I spoke to somebody, God, I think it was 2020, actually, we were talking about this. But it was an older guy, and he was basically saying, maybe it was a book, or was it somebody I spoke to? I don't really remember. But anyway, basically, this guy was saying that during the dot-com crash, all his friends were buying stocks. And then when everything crashed, literally all his friends never talked about the stock market again. They never invested in the stock market again. That was it for them. But he was well diversified, so he didn't suffer that badly. He did suffer, but not that badly as them. So he continued to invest, and then he made a lot more money, obviously. And that, again, is just coming down to that mentality and the psychology that people have. They see their portfolio crash and they think, I'm no good at this. That's it. I'm done. I'm out. They just want the pain to stop, essentially. It's the same with a losing trade. People don't let it run, not let the loser run, but people often cut trades early because they won't let it run. Like, I put a stop here, but then I'm cutting it early because I'm fearful that it's going to go down and hit my stop. But if I didn't cut it early, it goes down, doesn't hit my stop, and then goes on. It was all part of the plan. But it's just all, yeah, it's just very interesting. David, Luke, long-term buyers can soon become frenzied sellers when the market tanks 30%. Yeah, exactly. You got it. You hit the nail on the head. Watching from Jamaica, lucky you. I bet the weather is better than it is here in Calgary, where it's like minus something outside right now. And it's April, for crying out loud. So Canadian real estate is not going to crash, people. We are going to see new highs, records by summer 2022. Everybody remember that. We'll see about that. I mean, the fact that he seems so confident in what he's saying there tells me that there's a bias, because you cannot be that confident about something like that unless you have a bias. So maybe he's a real estate owner, owns lots of over leveraged and owns lots of different properties and whatever, and has bought lots of different courses from real estate people who say the market's never going to crash, because guess what? That's what they created a business on. I mean, yeah, we'll see. We'll let time be the judge of that, Bajinder. Who knows? You could be right. I could be right. Who knows? But time will be the judge. It's like musical chairs. The music stops and liquidity dries up. All of a sudden, you get a lot of no bid scenarios and prices drop like an anvil. Yeah, you're right about that. 100%. It's too true. Oh, even David caught that. David, you are on the money. Bajinder, have you just buy a house? Agree, Trader 586, Eric. And then, yeah. Oh, Trent, you just arrived. You are correct, Luke. I was just looking at buying, but now I'm not so sure. Yeah, human intuition is a powerful thing. A lot of people ignore it. I've learned to kind of follow it a lot, especially when it comes to trading. And it's just surprising that, our mind, it's just so much more powerful than we really give it credit for. Like, sometimes I'll get a bad feeling about a trade, and I'll just decide to take it off, and then I'll learn later that it was just completely the best decision I could have made. And I always follow through with that. And when I started trading initially, I never used to. I always used to just ignore it. And a lot of the time something bad would happen, and then you kind of be like, it was even worse. Like, it was a lot of pain. And that's the thing, you have to get rid of that pain completely, so that taking a loss is just as equal as taking a profit. And basically, that's the thing. People can't do that. Residential real estate, they have no idea how to take profit or anything like that. They just think it's going to go up to infinity. They don't understand the monetary environment that they're in. They don't understand that people lie. They don't understand that this isn't a perfect world that we live in. And they don't understand that it's a fraudulent system that they're participating in. So it's really, I mean, for some people it's sad. For a lot of people, they're gonna deserve what they get, because they've really just been so over leveraged, just so, like, a monkey could have seen this, is what I basically say. Like, just look at this chart. Let's just get this chart up again. It just shows it so perfectly. But yeah, just look at this chart. Like, look at it from it goes back to 1970, and you can pretty much see that, yeah, prices have been going up in real terms. But if you look here, prices were pretty much flat for over 10 years. Prices here were pretty much flat for 7 or 8 years. They went down. They were pretty much flat for nearly 12 years there. So, like, but you look at this is not flat. This is just up all the time. The only flat part that actually happened was 2 years, from 2017 here to 2019. And now we've gone parabolic again. So this is just not sustainable. This sort of thing is sustainable. And I think we'll see something like this, where there's a sharp decline, and then just it stagnates for decades and decades and decades. And I think that's really the likely scenario, that we'll see some sharp declines when the banking crisis emerges, and then you're just going to see decades and decades of stagnation in real estate prices in this country, because there is a complete oversupply. And I know that'll come. I know to a lot of people they'll be like, oversupply, but yeah, there is. So yeah, you make a good point there, Trent. There's 37 people in here and only 16 likes. Hit that like button. Yeah, you know, I kind of hate saying that all the time, but really with these live streams, it does actually help. The more likes the live stream gets, the more chances it's going to send a notification to other people saying that I'm live. And that's if they haven't ticked the all notification button when they subscribed. Like I say, just have it ticked, and you don't have to join every single live stream when you get the notification. You can just get rid of that notification, but at least you get notified, and it's not the algorithm trying to do it, which we're trying to get rid of by telling you to hit the like button right now. So that's basically how that works, the mechanics of that. Yahoo Finance. Eric says Yahoo Finance had an article today saying the Canadian government is expecting a shortage of tradespeople for housing for 10 years. Well, it's not just housing, Eric. I think it's a lot of different things. It is not just housing. I think it's everything. And I think it's really just going to pull into the fact that it's an aging population. The demographics are a mess. The immigration system is a mess. It's a complete mess. So I just think it's gonna be very, very interesting. But the thing is, even without the tradespeople, you know, there'll be a lot less demand for tradespeople for real estate construction once there's a crash. I can tell you that. There'll be little to no demand. So they'll go from an undersupply of tradespeople for working on houses to an oversupply. And that's basically how that'll work. But right now, there's so many housing starts happening that, yeah, there is a shortage. Like housing starts are just massive right now. So, yeah, doing great. Just got back from Costco. Nice. How was the gas lineup at Costco? I bet it was absolutely insane. I just bought more. David says, I just bought more shorts over the Aussie index. You think Canada is a mess? That country is a smoldering pile of dung. Yeah, you know, I should really look into Australia some more. I know they've got this similar issues with real estate property bubble. They also dodged 2008 through similar things to what Canada did. It's incredibly interesting. The reason it can't continue is the debt market, Trader 586 says. That's the difference this time. The debt market is forcing the hands of the banks. And I totally agree with that. I think that is fantastic thing to put. I couldn't agree with you anymore. The debt market is forcing the hands of the banks, and not just the commercial banks, but the central banks. And I don't think that's going to stop. And I think because bonds are an open market and they're sold a lot to investors overseas, a lot of people from China buy government bonds from Canada. There is so many bonds that haven't even hit the bid to sell yet. So it's going to be very, very interesting what's coming. So it's HP says, well, I came back home to buy and suddenly prices went sky high. So I said, no, I am not buying unless prices drop to 2018. I will not be made fun of. You know, it's good that you have a plan, because that's really going to help you. You know, a lot of people will try and time it and they just won't be able to do it because they have a bias. But at least if you have a plan of, I want to buy here because X, Y, Z, that's a good plan to have, in my opinion. Just have some sort of a plan at least. Don't just say, I'm just going to wait for the bottom and then buy. Like, try and find that bottom where it's been historically. I know it's really difficult to do, or at least wait for the bottom to go in and then the market to turn, because that's the only way you're going to know it's really the bottom. So they did dodge it in 2008, 29 years without a recession. Does that sound right? Yes, it does, because that's exactly the same as Canada and probably New Zealand as well. Well, I should say without a prolonged recession. Let's be clear here, without a prolonged recession. They have had recessions, but they've been like very, very short. More people will want to work, so I suspect more people will enter trades. Yeah, you're exactly right. That's very good. It's but yeah, so basically, anyways, guys, I'm gonna leave it there. I'm gonna go to bed now. It's only 7 o'clock. But I am so tired, and I hope you understood me during this live stream. Please smash that like button so people see this video, and I will probably see you guys tomorrow, because we have so much news and things that are happening over this week. We're going to be seeing each other many times, fortunately or unfortunately, depending on which way you look at that. All right, guys, peace. Thank you so much, and I will see you guys in the next